Hello and welcome to the Core Reports Weekend Edition. The big question people always ask when it comes to the stock markets is when to invest. Of course, you could also ask when to sell, but right now the question is whether or when to invest. And the reason is there is some apprehension around the markets, and this is particularly timed to now because there are general elections going on and results are expected soon. On the other hand, the markets are at an all-time peak or close to it, and at the same time, you have investors and fund managers who've spent many decades looking at this market. I'm pleased to be joined today by A. Balasubramanian, the Managing Director and CEO of Birla Sun Life Mutual Fund, who's been, like I said, in the markets for almost 3 decades. And I hope to learn from him how to really navigate the stock markets at this point, or for that matter, in future as well. Bala, thank you so much for joining me. So the reason I picked this time to do this conversation is the markets recently hit peaks. We were at 75,000 on the Sensex. And of course, the markets have been steadily hitting a peak for more than a year now, and even more actually. So the question, as many people ask me who listen to the Core Report, is that, should I invest now? Is this a good time to invest? Are the markets too high? On what basis should I form my investing strategy at a time like this? That's one part of the question.
Yeah.
The second part is, I'd like you to lean on your own experience. Now you've finished a clear 3 decades in investing, which is a landmark in itself. And 3 decades has, I'm sure, taught you a lot. And has, if nothing else, sort of strengthened your resolve and your focus in terms of what to do and what not to do, including in times of panic and in times of exuberance.
Yeah.
So let's start with, looking back 30 years before we come to the 75,000.
Sure.
And as you look back, what are the key lessons?
Sure. No, thanks, Govindraj, for having me part of this show today. I think this 30-year experience has given me the opportunity to look at various market fluctuations, various crises that came and hit the market, shook the confidence, and whether it is from interest rates, whether it is from global market going for a toss, or emerging market crisis, or even the global financial market crisis, scams, multiple scams. So all those things have taught one thing, being in the investment world. These issues will come and go. They are not permanent in the system. What remains permanent in the system is the hope and optimism that could drive the economic growth next level. Second is how companies are being built for building the business for the future. They are building the business for the future. Therefore, how much they are committed to build the future, and then accordingly work backward in ensuring you make the right investment and generate profits, increase your customer base, and so on and so forth. I think if you look at in that context, every crisis, if somebody has made an investment, they would have made actually more money than somebody would have just remained invested in the market. So that's the way I think I see the experience of 30 years comes in handy. Second is, which again the experience has always taught me, general noise levels when the market turns negative is far higher than the noise levels when the bullish market remains. And the bullish market, not everybody will be skeptical. Whereas the bearish market, there will be more people who will become skeptical, saying it was known, it was supposed to fall, and so on and so forth. Therefore, they sit on the fence. So, a number of people actually go to the fence, not considering any investment, thinking that market will come down further, therefore, let me time my investment. And invariably, all such people would have remained outside the market without, by being worried, and not looking at the big picture that could drive the market to a higher level. That's something also I've learned, that you have to ignore those noise levels, be brave during that period of time, and put a leap of faith in the equity market for long terms. Therefore, the optimism, a little bit of hope, a little bit of conviction, yes, our economy will do well, market will do well in the long run, and therefore you must make the investment. That has been my biggest experience. But during that period, managing volatility, managing vulnerability, managing uncertainty, they're all part and parcel of the game. So how do you do that? Only through asset allocation, nothing else. You can't be a perfect investor, except managing your downside risk by focusing on asset allocation and so on and so forth, or focusing on staying calm and cool during the period of volatility, and then stay through the whole crisis. Then you become a winner. That's the way I've seen my 30 years experience. Coming back specific to the market, I think you first of all asked a question about market touched all-time high. In my 30-year cycle, I would have seen market touching all-time high multiple number of times. Because every market has to touch a new high. So when the index was 3,000, definitely 10,000 index was new high. 10 becoming 20 was a new high. 20 became 50 was a new high. 50 became 70 was a new high. Maybe all probability 75 also will go to 1 lakh. Say maybe the next say 5-6 years. So new high is actually the question of how you see it. And second is market always discounts most of the stuff well in advance. As I mentioned about hope and optimism, is the one get discounted in the market, because market first move first, and then the result should come. When the result doesn't come as per the expectation of the market, generally market has got tendency to give up temporarily, because it's not met the expectation of the street in large or money manager in large. Therefore, the market has a tendency to give up. So sometimes you see the volatility in the market, that is more of giving up, of not being met the expectation of the predictions. So that's why the market, otherwise it doesn't change the fundamental. Fundamental remains constant, and P re-rating and P de-rating both actually is seeing the market price movements. That happens on the basis of the expectations being met, expectations not being met. So my own belief is what we are seeing after touching 70,000 index, we are seeing some bit of volatility. But we have to remember, volatility as a percentage, if you see, very small. In a market which has gone up by 70,000 index, suppose it falls by say 1,000 points, it's only 1%, 1.2% fall. But the same 1,000 point fall, assuming it happens as 50,000 index, is almost close to about 2% fall. My belief is as the market is becoming more and more matured, I think fall will be relatively less bearable, it can be tolerated. At the same time, one need not necessarily get worried as if this fall or fluctuation is going to make me suffer big time. But anyway, every market has to go through a period of consolidation. I see a period of volatility. I also see a period of consolidation, nothing but sideways. It can frustrate you that why it is not going anywhere, because people want movement. It has to either go up or come down. If it remains flat in the range of say 1.5-2% kind of range, there is generally frustration level also gets set in.
And we've seen those periods many
times. We have seen those periods. In my own 30-year period, I have seen all this. I have seen a period of consolidation. I have seen a period of as if the world is not going to survive tomorrow, especially global financial market crisis. All of us felt, being in the financial industry, whether it is the right industry to be there. And a lot of people are actually looking for a job outside. Something happened in internet bubble, made a lot of people actually quit IT industry to come into the financial market and other industries. Whereas those who are stuck to the same industry in technology, they would have made tons of money, both in terms of salaries as well as wealth creation. And same thing applicable for every industry, I would assume.
Did you ever feel in 2008 that you wanted to leave the industry?
In fact, 2008, after the global market financial crisis, it did occur in our mind, are we in the right industry? Is it something we should change our industry, go to the traditional manufacturing industries, or take up something which is more stable, where you don't have the fear of job losses kind of things. But fortunately, the way regulator at that point of time came heavily to address the issues, and we are all involved. In fact, even myself, along with some of the industry colleagues, were involved in finding a solution, working closely shoulder to shoulder with the regulator and finding a solution. In fact, those solutions fell in place pretty fast, and we're all more managing crisis to boost the investors' confidence rather than looking for a job outside. But it did occur in our mind, are you in the right industry? Of course, more than me, I think it did happen for many of the people who are working and my own colleagues. They jumped the jobs for greener pasture outside. Then suddenly they discovered they got caught in the wrong place. A big organization failed. Then suddenly realized they took a wrong move. So those things also happen. And even in US especially, people start thinking there's so much of job losses coming. In fact, the financial service industry has become one of the largest industries even today. And somebody had not moved away from that industry, definitely they would have made their life a little more better.
So you talked about asset allocation, and that's one reason, or that's one approach to making sure that you get a good night's sleep, even if things go suddenly south. So tell us about that approach, and has anything caused that to change in the way you allocate assets in the last, let's say, 2 or 3 decades?
See, asset allocation is something, I think within the equity space, one is the broad market itself. And as the market becoming bigger and bigger, they generally tend to grow lower than rest of the market, and therefore the stock performance is linked to the index movements. As we go down the market cap, I think as you start finding tomorrow's large cap companies today when they are small, which essentially means they generally tend to grow faster than big companies rather than mature companies, and therefore unlocking a value generally is high. And eventually, if they are able to succeed, they tend to generate multiple returns for the investors. So that's something I've seen most of the time. Why I specifically pointing this analogy, there is a tendency that small and mid cap means is risky. It is risky, no doubt, because the small size companies generally not risky. But the same small size company have a vision, good management, they are in a good product, they are in a good business model. The general tendency to grow in scale and becoming larger ambition also helps in unlocking value. Therefore, within the equity allocations, one being part of Nifty related product, which is basically large cap oriented investment, mid cap oriented investment, and small cap oriented investment, that should come as part of the asset allocations. The moment you have this asset allocation within the equity, anyway you have to take a risk. Once you take a risk on equity, high risk, high return, and within that you need to focus on asset allocations, which is basically good mix of large cap, mid cap, and small cap, and thematic. That's the way I think India has progressed. So that is one I am referring to asset allocations. Second asset allocation is about for somebody who cannot take very high risk. His model is not about taking high risk, high return model. He is happy with related lower return. Then he must have some fixed income related portion of the portfolio in the fixed income component. Because fixed income gives a higher accrual, gives a stability, it acts as a cushion in market volatility. That should also build in as part of the asset allocation. That's why I meant about the allocations towards these asset classes. Within the equity, the space is quite wider. You can't just stick to only one. So I have investment in FT, large cap focused investment, and therefore I'm happy, which may not work. Maybe you are taking a 20-year call. You rather take the risk, which I think can reward you better. With 20-year call. If it's a 2-year call, and then definitely 1-year call, 2-year call, definitely you can't have the same argument. When your investment is for a longer period, you rather take the risk through the allocation model, and within that you have a higher allocation towards high risk, high return, as long as your investment time horizon is say 15 years, 20 years. Shorter investment horizons, then you focus on Nifty related large cap. And then if you are too conservative, definitely have some bit of cushion in the portfolio, which is nothing but adding fixed income to the portfolio also gives a better result.
So I'm going to come to the overall portfolio. I mean, almost $36 billion worth of it. But somewhere mid cap and small cap suddenly became a bad word. I'm talking about the Indian markets. Now, compositionally, the way you're saying it, this was always there. We always had the larger caps, and if you were really betting on the future, you were to look at stocks which by definition were smaller cap.
Correct.
And then why did this distinction happen? And in a way that suddenly, obviously, I can see that values have shot up so much that everyone is now putting the microscope on it.
Correct.
But why did this distinction happen, and what is the learning for it from this? I mean, is it? And particularly when you look at the future.
So I think the market, the way I have seen in my own 30 years of career, when the market goes through cycles, there are cycles which is bull cycles. General tendency for mid-size, small-size companies to do well and grab the attention of investors is far higher. Therefore, they tend to run faster, they tend to perform better. And as the price movements becoming more and more stronger, the tendency to participate on such investments by the larger audience, investing audience is also high. That's why the euphoria comes.
Yeah.
The moment euphoria comes, the valuations goes outside the acceptable, the institutional investors limit or maybe regulatory limit. Therefore, some speed breaker has to come. I think if you look at in the market, there has to be always some speed breaker. I think when the market rises fast, I think we should not restrict only to the small and mid cap. Even the large cap also, it's applicable. Speed breaker is applicable. Only the question is, what kind of speed breaker you want to give, whether you want to have frequent speed breaker or you want to have a mild speed breaker, depending upon which segment you are. So the way regulatory intervention comes, the way we as a mutual fund also stop the flows in small and mid cap, all these things we should call them as a speed breaker. So this speed breaker is always essential for the healthy market momentum for the future. Because at the end of the day, the noises which comes in, overvaluation, sometimes the market is always mindless. I think if you leave it to the market, They'll always look at sky is the limit. But from a market stability point of view, regulatory point of view, or people like us, mutual fund player like us, we are here for long term. We must ensure orderly movement of the market is more important for me than actually a substantial rise in the market is important for me. I think orderly movement of the market is more important for me. So therefore, we must put a speed breaker. The noise what you are referring to, which came from a regulatory side, and we are also of course part of it as industry leaders in coining the right disclosure norms for the entire purpose, is to actually more intention to make people aware, be aware there is a speed breaker, therefore please go slow on your investments in this segment because it has hit the limit, therefore valuation will get moderated and so on and so forth. But then the market has its own brain. But
it's all come back in any case.
It will come back in any case. That's why if you look at the market cycles, see if you look at 2019, when the credit market crisis happened, the entire mid-cap space got hammered. A good period of 16, 17, 18, beautiful return, fantastic return, smaller mid-cap as the only segment to invest, that was the theme which was coming in. Whereas 1920 was bad. But after COVID, as time gets progressed, the MSME guarantee was coming in from Government of India for lending money, the whole, the mid and small cap space picked up. And they have given return in the last 2 years, which they would not have got in the last 7 years. So market always got the tendency to give, rather bump up the return on 1 or 2 years, for which unless you stay invested, you will not get the bump up return.
So we are talking about valuations which are, let's say, at a point where we are not able to make out. As you said that, at any point of time, whether it's 1,000, 3,000, 10,000, 50,000, valuations constantly keep rising. And that's a fair argument because the economy is growing and earnings are growing, so everything is keeping pace. But why are we not applying the same argument when it comes to mid-cap and small caps? Why did we panic there?
No, the panic is because of nothing else. I think it's panic because of ownership. I think if you take a 10,000 crore market cap company, if the promoter owns about say 60% or 70%, the free float is less. And when the free float is less, when more and more participation comes in, the demand is far higher than the supply that is there in the market. Nobody wants to sell, but demand comes. Therefore, there is a feeling of the price movement is not fully supported by liquidity in the market, and they are illiquid in nature. Therefore, the price discovery is not necessarily driven only by earnings. It's also driven by the demand-supply situation. Is more in favor of supply. Therefore, in such a situation, then you actually bring in the valuation. Then the valuation gives you a mirror. This is a valuation. You understand the risk that is involved. When you want to still make investment, that's something money managers apply this principle. Sometimes even money managers may get it wrong. But for common investors, when money managers get it wrong, a common investors can get it more wrong actually. So that is why I think valuation will bring in the picture and this thing comes in. It's more to supply to a demand situation.
So the investing strategy question is that what should I therefore not be investing in, or what should I be careful of when I invest, if I were to invest on my own, or if I'm watching my mutual funds investments? What are the red flags when it comes to the kinds of investments which, in keeping with what you said just now, as in promoter ownership, for example?
Now, I think from wherever the fundamentals are not supporting the price rise, which is driven by earnings, cash flow of the companies, dividend track record, tax paying track record, and the business itself should be sound enough for you to also feel it. I think most of them you can feel the business, whether it is service or a product, you can feel it even as an investor. If you don't get that feel, but you still feel happy about price rise, then you must not get carried away with that. That's something one must avoid as a principle. From a mutual fund point of view, you don't find that risk to large extent because we are diversified. Because mutual fund is a beautiful vehicle. Even if you make mistakes, the mistake is always a small component of the overall portfolio. It's a drop in the ocean. As long as it's more like a drop in the ocean, even if there's an accident on 1 or 2 stocks, I should not worry because a diversified portfolio ensures that portfolio risk is taken care on the mutual fund side. But only thing that you have to keep in mind in mutual fund, that the investment that you make purely on the base of the past return is very high, therefore they will be able to sustain in the future, and somebody has done very badly, therefore he will not be able to sustain in the future. Both the assumptions are wrong. When it comes to question of investing, both the assumptions are wrong because market is a great leveler. A good performer gets neutralized in some years. A bad performer also gets neutralized in some years. Therefore, in the long run, more or less everybody generates a similar return with plus or minus a few basis points. Therefore, you must just keep in mind, chasing return is actually some of the worst enemy that you will create.
When it comes to mutual funds.
Mutual funds and stocks, of course, chasing return on the euphoria.
Okay.
Yeah.
So one of the things that's clearly changed when it comes to mutual funds is the sheer supply of investments into mutual funds,
Correct.
right? Particularly in the last 2 years. Now, a very broad question first. How do you manage these flows?
See, the flows you can...
and I'm sure you feel good about it on some days, but I'm sure on some days it must be a concern as well, right?
See, it's a good problem to have. In the sense, we always used to sit and pray that mutual fund should be the large player in India when FIs takes our market for a ride. And today it is the reverse. When FIs sell, Indian mutual funds have become the large buyer of equity. They are the great stabilizer. They are leveler in the market. They have become very serious player in the Indian capital market. Therefore, it's a good development, good problem to have, both from the government point of view, regulation point of view, and as well as from the country point of view. Second is the mutual fund coming in with the more and more companies are now tapping the equity market more than the debt market. Earlier, say if you take 90s and 2000 period, the number of companies who used to fund the business through the debt was far higher than the number of companies used to fund the growth through the equity. Today, every company after the financial market credit crisis in 19 and 20, most of the companies have realized the best way to build my business through the rising equity and have a less dependence on debt. That's a cultural change that happened in the company's business model. Therefore, the flow that is coming is also getting absorbed not by the existing listed companies. Most of the IPOs, fresh fundraising being done, they're all getting funds through this fund that is coming in. But in terms of flows, moderation. Moderation, of course, happens. Moderation, of course, happens through the intervention by all of us as money managers. We stop flows in some schemes. We reduce the flows only through an SIP so that we come for long term. And also tell people actually, I think valuation is too costly. Therefore, you must come in the large cap fund rather than going into the mid cap fund. Of course, when the market crashes, everything will come down. Whether it is a large cap market, when the sentiment changes, it doesn't care about valuations. It just falls. And we will go through that period also. But the only thing is, you can always, by reducing your flows, you can, of course, you can give that message to the investors in a euphoric market, in a market which is quite high. Don't get carried away saying that same experience of last 2 years will come. It's more of forewarning. But otherwise, flows in my will come because as long as the flow that we receive is a long-term in nature. When I mean long-term in 3 to 5 years kind of nature, I think we should not worry given the fact that Indian economy will become $10 trillion economy, say, in the next 5-6 years, which essentially means market will also become $10 trillion market cap. I think it's a direct correlation is there, if not a premium. Therefore, the flows we don't discourage too much. At the same time, we moderate the flow.
So the overall financialization of the markets, and that's something you've talked about in your investors letter as well this year. Now, that's something that's going to keep driving funds, let's say, from savings into equities or mutual funds, basically non-savings opportunities.
Correct.
How do you see that going ahead? I mean, because we are still coming off the COVID, and COVID created some shifts in our behavior, some shifts in expectations, and there are some other problems, including inflation and so on. But do you feel that that's going to continue in the same way, or could there be new shifts?
I think it will only increase. The reason I see the financialization that we have seen in India in terms of savings pattern moving towards various other products. And before that, the payment banking revolution that has happened in the country through the mobile banking and then the smaller banks reaching out to the nook and corner of the country. The way NPCI has actually made payment very easy from mobile to mobile and so on and so forth. Access to the information, various platforms have gone up. Awareness about investing in financial market instruments have gone up quite significantly. Thanks to, of course, mutual funds IA initiative that we have taken in the last few years, increase the financial literacy. RBI is doing their bit, insurance doing their bit. I think their whole awareness about investing has gone up quite substantially. So therefore, my own belief is gradually, I think as we move forward, the traditional investment versus new investment. Traditionally, I am talking about FD, real estate, gold, silver to some extent. These are I call it as traditional investment. I think there will be a shift to the traditional investment towards capital market assets, including mutual fund equity schemes and equity and fixed income mutual fund schemes. They would actually start forming the larger component of the, because people understand savings. People are understanding it. People know if I put money, I can take it back. I think I would give full credit to boost the confidence of investors to the regulator in every field. I am talking about Reserve Bank of India, SEBI. They have done a fantastic job to ensure no investors are made to suffer because of lack of information or lack of clarity or disclosure, lack of disclosures. All this have become so powerful. Today, investors can take very informed decisions. Therefore, more money will come into the capital market assets as you move forward.
So let's say you collected 100 rupees in the last 1 year across everything. How much would have come through SIPs and how much through one-shot payments?
65% of the flows that comes through SIPs.
Okay.
I'll just give you one number of last year. We just closed the year in March 2024. The March 2024, the full year, the industry got roughly about 3 lakh crore inflows. Out of which NFOs contributed roughly about 55,000 crores. All new investors came through the NFOs because a lot of people come with the new schemes. And roughly about 70,000 crores came through the arbitrage fund. Almost about 1,60,000 crores came through the SIPs out of the 3 lakh crores. Which is, if I knock off NFOs, knock off arbitrage funds, and you keep NFOs as actually equity flows, almost about 60% of the flows have come to the SIP, which is a fundamental shift from the behavior of the investors, from moving away from lump sum investing and then start looking at how their performance is coming. Instead of that, making investment through SIP, agnostic to the market performance, looking at long-term investing, that's something is a fundamental big change that has happened. And second is perpetual. I think people used to sign up for SIPs for 1 year, 2 years. Now people sign up for SIP for perpetual. But they know very well that I can always cut my SIPs whenever I need my money in my bank account instead of SIPs, a payment that I have to make. So people have started signing up for perpetual. Therefore, they end up doing SIP for a little longer than what they would have done. Therefore, the SIP average period would be roughly about 4 to 4.5 years.
So if you collected, let's say, 160,000 crore last year, so therefore it stands to reason that you will collect as much this year as well from the SIP route.
Yeah, I think this will continue. I think SIP has now become the accepted way of investing. Sometimes I tell people, jokingly, whenever I address a large audience as part of their mutual fund promotions, including Aditya mutual fund product, when we promote, I do ask this question that how many of you sitting in the room have invested in mutual funds? Assuming 100 people, there will be about 20 people raise their hand. The moment I ask a question that how many of you sitting in the room have invested in SIP, out of 100, 70% of the people raise their hand.
Okay.
So they are investing in mutual fund only.
But they don't know.
But they do not know mutual fund they are investing. They are saying in SIP I am investing for the purpose for which I invest, which is in my view is a good fundamental shift in mindset of the investors looking at the long term, agnostic to the market. This in my view is a big success has come for the industry in changing the behavior of investors, how to invest in, how to look at investing in equity market through the mutual funds for longer term purpose.
Okay. So I'm going to come to some of the final questions and that will be more specific now. So the first one is, how do you as a fund manager stay ahead of the game? And how do you also convey to your investors or other investors that you are ahead of the game?
So of course, looking beyond say 2024, I think you look at the future. So I think for a money manager job is literally tough. All the time you have to look to the future, whether it is an economic growth, whether it is holding high optimism on the economic growth itself, leadership, earnings of the companies, and then sectoral rotation that could happen on the basis of the valuations and what's happening in the sectors. This is something is the regular exercise that we do. We do an annual survey within our team that which are the sectors which could outperform next year compared to last year, and then we do communicate that. Not necessarily all such predictions that we make always comes true or 100%. You will get, as long as your hit rate is about 60 to 70%, we should be happy. This is one way, of course, we do it. We also do an annual survey with the external world to get to gauge the pulse of the consumer behavior or the reflection of our distribution community in terms of what they feel in terms of the economic growth, market momentum, and so on and so forth. And that also gives us some sense in terms of where the street is thinking and what is our thinking, and then see how to map these two things and see to it we derive some conclusion out of it, on basis which build our futuristic business model. That's something we communicate even annually, we put out a report. Second, of course, the way we do is we do an investment voyage event every year religiously. For the last 12 years we are doing it, because the external experts coming from various parts of the country and speak on sectors and economy and so on and so forth, including international development. That gives a sense in terms of where each of the moving parts of the economy will further move ahead, on basis which you have to form your thesis. So this is why I think this is a repeat exercise.
What would be something interesting that you picked up in the latest investment voyage?
So the latest investment voyage, one of the things that came is on the interest rate front, whether interest rate is going to be cut or is going to stay longer. I think clearly we came out of the meeting and that one day conference, interest is going to stay a little longer, higher for longer. That's the theme that we brought in. Second is, okay, there are certain sectors which are the movers of the market, like manufacturing and capital goods sectors. They have done pretty well, but the thing is, you continue to hold your positive view or not hold your positive view. I think we came out very clearly, there's so much is happening in the country, you can't afford to be underweight, you cannot afford to be negative, because future earnings will be substantially higher than what you are saying.
In which sectors?
In capital goods sectors. Okay. Capital goods sectors and as well as the manufacturing sectors. And third is the consumption as a theme have been a bit low for the last few years. The rising income in the country, can it lead to a significant uptick in the consumer segment? Again, that conference gave us some insight that the consumer segment, having gone through a 2-3 years of a period of consolidation, we will probably see spending habits increasing, therefore the sector should do well. In fact, we are already seeing it. For example, AC sales, thanks to the higher heat, the sales have picked up.
Yeah.
And these are some of the things which came as part of the discussion that we had in investment voyage.
Right. So if you look at, let's say over a 15-20 year period again, I was reading something Akash Prakash, the fund manager, wrote, and he said that the thesis that worked for let's say the last 15 years, which was more consumption driven, high quality stocks, buying the levers in HDFC Bank, is not going to work now and has not been working. And that's quite clear. So this is a 15-year turn, and he compared this to the 2003 to 2008 capex cycle. So are you seeing any such shifts in cycles now as you look ahead?
See, I think the way I see is, I think the high valuation companies, they go through time value corrections. I think if you look at pharma as a sectors, have gone through that period of consolidation, corrections, and now, therefore now it become relatively cheap in terms of valuations. And the sector will remain one of the core segment of the any country. Therefore, we felt pharma sectors can see a turnaround. And they have gone through that period of pain, they have gone through the period of consolidation, they have gone through the period of high valuations. That's something is coming, because ultimately from market point of view, you cannot ignore company which generate free cash flow. You cannot generate company which has got a high dividend track record, and you also cannot ignore companies who are part of the core part of the any economy, so to speak. So that's something I see as a trend in pharma sectors. But what Akash mentioned about sectoral rotations does happen. The traditional sectors, which are part of the core segment of the market, and my own belief is eventually they give a good return. I think there are companies I have seen last 15 years, if you take, they given a fantastic return, either the Nifty return or above Nifty return.
Sure.
But there are certain pockets, because of high valuations, they are not given a return. That should not be should be used as a period of bad period for them, because they all go through the consolidation period. But the sectors which are, I call it as a domestic cyclicals, which is basically the local manufacturing. This is where I think my own belief is we'll continue to see a significant uptick compared to traditional businesses, because that is a segment which has suffered for the last 2-3 years or 4 or 5 years, because lack of investment, either coming from the government of India or coming from private sector, which is now beginning to pick up. Therefore, that sector probably will have a bit of long rope in terms of their performance. Look at the public sectors. I think public sectors today, if you ask a fundamental question,
huge valuations. Yeah.
Huge valuation. They are undervalued. But you ask a fundamental question in terms of where are they lacking in terms of technology investment? Are they poor on digital? Are they poor on leadership? Are they poor on product segmentations? Are they poor on execution of their services? If you ask questions on each of the areas, you will not say they are bad. So if you compare the private sector bank's app versus the public sector bank's app, from a consumer ease of doing business point of view, more or less remain the same, if not the same, some cases even better. Then ultimately the market recognizes that. Therefore, the value unlocking happens. So that's what I think we are saying. And beyond the point, once the value gets unlocked, the question is, you want to give the same valuation as any other private sector company in the same space, or you want to undervalue them because they are of different kind of nature of business. But that is where I think market comes into play and helps in re-rating them, which is what I think my belief is happened in the last few years, and my way will even continue to happen. Ultimately, market rewards efficiency improvement, whether it is on leadership or on a product profile or on the cost versus profitability.
Right. So last question. So there are many mutual funds, and you said that over time a bad mutual fund could perform better, and a good mutual fund could not perform so well. So it sort of evens out. So today, if let's say you are trying to attract capital, though I know it's coming without you asking for it, what would be, let's say, the distinguishing aspect of a Birla Sun Life mutual fund versus someone else? Or if I were to look at about 5 mutual funds, how do I choose? And what is it that you feel I should use to choose either you or someone else?
I think interesting, Govindraj. Right now, as I speak, this is our 30th year of existence. Somebody who has been a part of the industry, 30 years, being one of the old player, having seen cycles, and become a large player in the mutual fund industry, without having a bank as a promoter, except the promoter is of course Aditya Birla Group, which is a strong power, high power name, brand name in the country. Now we become the large player. That shows the commitment of seriousness, commitment that the business brings on the table for the investors. That's one. And having seen cycles, it actually helps in have a proper risk management. As I speak today, I was just chatting with somebody. Some of the boutique managers, I'm told, they are not getting the mandate from overseas investors as they used to get in the past. Not because they are poor manager. I think beyond the point, it's not managing money alone is important. Generating return alone is not important. Managing the risk along the side is also equally important. Today, managing risk is also become one of the major components. And people like us, Aditya Birla Group, Aditya Birla Sun Life Mutual Fund, have invested heavily on people, on processes, on risk management tools and software that you need to build, automations, and enable the right sort of people to perform better in all market cycles. But for a few cycles, we go through ups and downs. But as long as you have wherewithal to come back, this is something we have as a fund house, having seen all the cycles, having made mistakes, taken good decisions, bad decisions, is a mix of everything, and still we are doing well. And that's the way I think one should look at it. This is, I think, globally people ask this. People do pay attention in global market. That's why most of the large firms in the US have become large, despite may not be necessarily giving the same experience as any boutique firms, because of the nature of the business model in which they are built. I think Aditya Birla Sun Life Mutual Fund, I take pride being part of the AMC for the last 30 years, and how the AMC has done well and the best interest of investors and other stakeholders is something even investors should pay attention while interesting his money.
It's a very optimistic and nice note to end on. Thank you so much for joining me, Bala.
Yeah, thanks, Govindraj. It was a pleasure talking to you.
Likewise.